Hey Leon, and within the blink of eye, we
We
are
are
back.
back.
And this is one of the serious topics we're going to
Mhm,
talk about today,
mhm.
right?
Right.
And
How
maybe,
serious is serious?
well, I think this is something we actually
Mm.
know a little bit about, right?
Mhm,
At
mhm.
least in the insurance industry that we are in as well.
You mean in all the other topics we knew nothing about?
Well, there's a little bit of professional knowledge, a
Okay.
little bit
Yeah.
more, right?
Yes.
And
Yes.
also work knowledge as well. So
Yeah.
some
Mhm,
exposure that we have
mhm.
into this everything else. Have you heard of anyone come to you? Obviously,
Yep.
in
Mhm.
your experience as an investor and
Yep.
everything else, say,
Mhm,
Leon, you
mhm,
should take more. You should borrow more money. You
mhm,
should borrow more money
mhm.
and buy this stock, right? Because
Yep.
it's a definitely surefire. And if you're not going to do it,
Yeah.
you're going to lose big time.
Well, many a time, right?
Yes,
Buy this stock, buy that stock,
buy
right?
stock.
Why?
Why?
Oh, some insider information. There you go. Ooh.
And a lot of times when they say sorry, I don't have money to buy
Yeah.
the stock,
Yeah.
then they
Yeah.
come up with a
Yeah.
very
Very
innovative
innovative.
way.
I would say innovative. It's been there for donkey years,
Correct,
right?
right. Fair enough,
Yeah.
right.
So
So I draw back the word innovative,
yeah,
very established.
established is a very established practice.
Yes,
It's
and there's no it's established practice. Correct. Yes,
using a generic term is just called leveraging,
yes.
right? But obviously, a more technical term, margin
Financing.
financing, loan
Yes.
financing, whatever we call it. In a way, even our home mortgage is on margin financing, right?
Right. So again, it's how you look
How
at it.
you look at it,
Right.
right?
So it's
Right.
just at the end of the day, it's
Mhm.
just a packaging.
Correct. It's
Right.
just a packaging.
So that's
Mhm.
the topic of the day today, right? So it's
Correct.
about margin
It's
financing.
about margin
And the
financing.
reason why we want to talk about it, I think it's very timely. I mean, we
Mm.
know the Feds are cutting interest rate.
Yep.
We had a massive 50 BP, even though a lot
Yep.
of people think you should not have gone
Mhm.
that much and everything else. And there might be another two rates
Yep.
coming down
Yep.
but in this year as well.
Yeah. November, December.
Yeah, so as interest rates goes down,
Mhm.
certain
Mm.
things come up to the surface,
Yep.
right?
Yep.
And margin
Mhm.
financing
Yep.
is things that has been around,
Yep.
right? And obviously it works well when interest rates are low,
Mhm.
not when it's very high,
Correct.
right?
Correct.
So maybe for most of the audience, maybe you can explain in a very succinct way what margin financing is.
Well, margin financing essentially, in very layman terms, is borrowing money to invest.
Right.
Right. Full stop. And you hope to borrow at competitive rates, and you hope to invest in instruments that bring you obviously more than the interest rates.
Yes,
Mhm.
yes, okay. So this is very specific to borrowing money to
Yeah.
buy stocks,
Yeah.
right? But obviously you can apply in different fields
Yeah.
and different areas.
Correct. Right. I mean, you can even apply to properties, right? A lot of people buy their second properties again, paying what 20% or whatever. The rest is all loans.
Yes,
Yeah.
yes. And obviously when you buy properties, I mean, they tell you that it's
Mhm.
one of those things that your
Mm.
over time your collateral increases, right?
Yep.
Your
Mhm.
value increases, but
Mhm.
your finance at your original value,
Yeah. Yep.
right?
Correct.
Okay, so that's one of the upsides of property. At least that's what we.
Yep.
So by the end of the day, don't mistake it. Not you are taking leverage,
Correct.
right? You are taking leverage, and that's why there's big concern about people overtaking the leverage. And then right now, if you're buying a property,
Mm.
you have to abide by
LTV.
LTV ratio. I almost said I almost wanted to say LTVP. So we means
Okay.
that means totally a different
Yeah.
a different thing. So LTV ratio, right?
Mm.
Precisely to make sure that you do not take more risk on financing more than what you're used to.
Yeah,
Right.
that's the way the authorities are trying to protect people against their wishes to be more leveraged.
Yes, yes. So margin financing itself, as Leon was talking about it, everything, it is a tool, right? It's a way for you to get access to certain products and
Yep.
services, right? But obviously there is risk associated with that.
Yep. So, in a nutshell, when things are going well, which means, say, for example, if the things you are investing into are rising, it can work,
Right.
right?
If the word is if, right?
If, right?
Yeah.
It is a big if, right? So, for example, if you're borrowing at interest costs 2%,
Yes.
and if you're pumping into an investment solution that's bringing you 7-8%, you make a net margin of like 5-6%.
Right.
Out of
Right.
thin air.
Yeah.
Right.
Yeah. So listen to that, right? So there's a probability that you will lose.
Yep.
Right. There is a probability because the probability is staked on the fact that the bet that you're making on, right, goes the other way.
Yep.
Right. And we know the stock market, no one can make a call for the next day, right? There's a probability that it can go down, go up.
Yep.
So even the person who's actually making the leverage, right,
Yep.
he needs to be it needs to have a certain risk level,
Yep, of course, of course.
right?
Well, I mean, again, that's dependent on the solutions you are getting into
Right.
as well. For example, if you are borrowing at 2% and you are trying to invest in something that supposedly can bring you 15-20%,
Yes.
that sounds like a very high risk strategy,
Correct.
right?
Correct. Correct.
Because if it sounds like it's going to be very speculative.
Yes.
And there are solutions where you borrow at 2%, they are trying to park into something that probably brings you like 3.5-4%. That is probably of moderate risk.
Correct.
Yeah.
Correct.
Mm.
I mean, the concern comes into play when a person who's doing well,
Mhm.
with a very high risk
Yep.
profile,
Mhm.
aggressive profile,
Yep.
he's gone through his fair shares of up and down, and
Yep.
is very
Mhm.
comfortable with leverage,
Mhm.
interacting with a group of
Yeah.
people
Mhm.
whose risk level are
Yep.
very mixed.
Yep. Mhm.
Right? So imagine the guy who's a conservative
Yep.
person,
Mhm.
who's probably still having his fixed deposit,
Yep.
right?
Mhm.
Getting enchanted by
Hey.
this
Yeah.
quick
Correct. Quick.
money, right?
Yeah. Quick,
Because
easy
because
money
I'm creating
supposedly.
something
Yeah.
out of
Yeah.
nothing, right?
Yeah.
I'm borrowing 2%
Yep.
based
Yeah.
on whatever you have and everything else.
Correct.
Okay, and
Mhm.
then putting it into
Mhm.
something else.
Correct.
And nowadays, for example, if you talk about stock investing,
Yeah.
the brokerage offers this facility.
All of them.
Yes.
All of them. Just to talk to the greed nature
Yes.
in all of us. One thing to note is, as we're saying, if things are going well, we can actually make money.
Yes.
If things are not going well, you can actually lose more than what you put in
Yes.
because of the
Yes.
nature of the leveraging. For example, if you go to buy a stock, 1,000 shares,
Yes.
using your own money, $3,
Yes.
the max you will lose is
$3,000.
$3,000,
Correct.
right? But if I'm using margin financing or one of those facilities, you can end up buying 10,000 shares because you're borrowing money.
Right. Right. Right.
And
Right.
if you lose, you're going to lose $30,000.
Correct.
Right.
Correct. The caveat here is that not everyone can get margin
Correct.
financing, right?
Correct.
You got to have a certain kind of collateral in your
Mhm.
account,
Mhm.
certain amount of volume of shares you
Yep.
need to
Mhm.
own.
Mhm.
So the margin or the loan they're
Mhm.
providing you is against this collateral that
Yep.
you have,
Correct.
and they give it to you at a very low interest rate, so that you're able to borrow
Mhm.
from them and put it into the market.
Yeah. So the nature of the beast is such that if the value of the collateral goes up,
Yes.
meaning your investments go up, you can actually borrow even more.
Right.
Right.
Right. Right.
Consequently,
If it
the
goes
value
down,
goes down, you end up with this thing called a margin call. Right, your
yes.
broker will be calling up, "Hey Suresh, how have you been? Hey, by the way, I just look at your numbers and you're triggering a margin call. Can you top up $5,000 between now and tomorrow afternoon? Right?
Yeah. Yeah.
Otherwise, we will force sell."
Yeah, and you don't want to be
Yeah,
end of a margin call.
yeah,
You
yeah.
don't want to
Right.
be end of
It
a
can be
margin
very
call.
distressing.
It can be very, very
Yeah,
painful,
yeah.
distressing. You
Mhm.
might, I mean, not just losing sleep. It can be a very traumatic event
Yeah,
to you as well.
it can be.
Given the fact that if it's really big
Correct,
sums of money,
correct.
right?
It can
Yeah,
have dire financial consequences.
yeah, yeah.
Yeah.
But having talking about this, but
Yeah.
do you think a lot of people in generally in Singapore,
Yeah,
let's
yeah,
not go
yeah, yeah.
use margin financing
Um,
to get to enrich
I mean,
themselves?
I don't have the numbers, but some of them do it for a more grounded reason. Like for example, just now we talk about stocks. It sounds
Yeah,
like we're talking about stocks, but you can also do it for example, some insurance policies,
right,
whole life plans, where the returns are not exceptionally high and they tend to be more predictable. Usually comes with a guaranteed portion and a bonus component.
right. So how so let's
Yeah.
good. So
Mhm.
moving to insurance.
Yeah.
So how does someone
Yep.
use margin financing to buy in this case, buy a whole life policy?
Yeah, so you typically can go through a financial advisor or a
Oh,
rep of a financial advisor or a bank, right? You say, okay, I want to buy this policy for X dollars, but I want what 60-70% to be financed through a loan,
right.
right? So essentially, it's almost like buying a property, right?
Yeah,
You don't
yeah,
pay everything up front.
yeah.
You
And
pay
the loan is given by the provider,
yeah,
the
yeah,
insurance provider
correct, correct,
themselves, right?
yeah, correct,
Okay,
correct.
okay,
So in a way, it allows you to buy a bigger policy than you otherwise could afford.
right,
The bank makes money, of course, because they loan you the money.
right.
The
Okay,
insurance company makes money, of course, because
Get the
manage to
premiums from you,
yeah, correct.
right?
So it's a win-win-win. It could be a win-win-win situation.
But so at the end of the day, when you come out of that, you actually paying both the premiums
Yeah.
and the interest for the loan.
Correct. But it's usually structured in such a way that the payout from the insurance policy should offset the interest.
Right. So when you say
Mm.
payout, right?
Yeah.
So if you're talking about whole life
Yeah,
policy,
correct.
we know it pays out when you
No. It can pay out after 3 years, 4 years.
right.
So it's structured in such a way that first 3 years you're probably out of what we call out of pocket.
Yes.
You've got to pay the interest rate because
Right.
there's nothing being paid out. Of the
And then
insurance
after
policy.
3 years
After
later,
3 years, the insurance policy should pay
and cover.
and cover and more than cover. So
Right.
you end up sort of like getting passive income.
Right. Sure.
Yeah.
So let's say, so it seems to me that in this product itself,
Yeah.
right? Firstly, you don't have that structure for all the insurance products. It's a
Correct.
selected
Correct.
insurance product.
Selected
Number one,
insurance
right?
product. Yeah.
And number two, like there is a certain period of time, initial period of the years,
Yeah.
you got to be cash out of the pocket.
Correct.
Right.
Yeah.
And this is more, even though the way it's structured,
Yeah.
it still is a product that you might still more prefer more when interest rates are low than
Yes.
high,
Correct.
because if it's high, then you're going to be paying cash pay out of pocket longer.
And probably exactly. So the good thing about doing it for insurance policy is unlike just now we talk about stock prices,
Right.
it can go up 15%, 20% a day,
Sure,
but it
sure.
can also go move in the other direction.
Sure.
With insurance policies, you're unlikely to see that kind of price movement.
Right.
So you're unlikely to have a margin call.
Right.
Right.
So there's no margin call. There's no such
margin. It's like, oh, sorry, your policy from.
So the only downside to anyone is being able to have the money to ensure the first few years of cash
Yeah.
out of your pocket,
Yeah.
you're able to pay it up, right?
Yeah.
That's the only downside, right? You can't miss that.
There's another downside.
Yeah.
Is a couple more. The other downside is you cannot surrender the policy early. As with a normal insurance policy, if you surrender early, you end up losing some value
on the policy.
On the policy, correct.
But the loan,
Yeah.
would you have any impact on the loan?
No, but
Okay.
you've got to repay the loan as well.
Right, because the loan is X amount of dollars, right?
Correct.
And it's based on the fact that the policy is not surrendered for X period of
Correct.
time.
Exactly.
Right? Okay.
So with a lot of policies, first few years you probably lose 20% you surrender.
Right.
Right.
Okay.
So if you think about it, if you would take on a 500k policy, 20% is 100k.
Okay.
Yep.
I did. Okay. 20% is 100K.
Again,
Yes.
as with a normal insurance policy that's financed through your own resources, you've got to stay for the long term.
Yes.
Mm.
Yes.
Mm.
Yes. Yes.
Yeah.
So again, okay. So these are so are these more
Mm.
towards whole life policies, premium financing?
Yes, usually they are.
Okay.
I've never seen a policy that lasts 15, 20 years that are available for premium financing.
Right.
Mm.
Right.
Yeah.
Sure. So there are risks
There is.
to taking premium financing as well. So
Correct.
imagine,
Mm.
so what happened when people taking the premium financing, the old interest rate regimen, when you had very low interest rate,
correct.
and the interest rate started popping up,
Yeah,
right?
like what we've seen. Yeah.
So started popping
Yeah,
up. So what happened? So everyone at,
Mm.
I wouldn't say margin call,
Yeah.
but they probably had re-rating of the interest rates.
Well, so for example, if somebody would take on such an arrangement in 2021 when interest rates were really,
Yes.
really low,
Yes.
they were looking at maybe 2.4, 2.5%.
Right.
And then obviously it's now gone up to 4.5%. Right?
Yep.
Yeah. So they have to pay more out of pocket in the first 3-4 years when the insurance contract is not paying anything.
Yeah. So that's assuming it's all a flexible rate. I'm assuming.
Yeah,
because
it is. It is.
It is. So it's always a flexible rate.
Yeah.
So
it is.
the
Correct.
insurance,
It moves.
so the banks do not
lock in for like 2
so
years.
they don't take absolute risk. They
Yeah,
push the
correct.
risk out of the market.
Obviously, the risk is
Of
out
course.
in the market.
So remember, right? There's no such thing as a free
Yeah,
lunch.
Yeah, correct.
Right. So okay, that's really nice. So we talked about margin financing as a concept. We talked about it in stock financing. We talked about it in the insurance insurance world as well. And there are other ways we can. A third way that we've actually understand how you can use margin financing, right? Pretty much buying overseas.
Oh yeah. So I saw as I forwarded you recently, I
Yes.
saw something from a popular funds platform.
Yes.
Sean, review the name to protect the innocent.
Yeah.
Touting, borrowing cheap money to invest overseas. For
Yes.
example, was it in August? We had this issue around what they call the Japanese yen carryover trade.
Yes.
Basically, investors were borrowing yen
And
at very low
low
interest
interest
rates
rate and
and
investing.
investing somewhere else, right,
Yes.
to get
The
again,
US
spread.
market.
US market.
Yeah,
right?
yeah.
but,
So
you know,
that's why when the yen interest rate, there was a big move
there
on
was
the
a big
yen,
move. Yeah, correct.
and there was a big
Correct. And that
backwash.
helped fuel the tech bubble as well. Yeah. So I mean, this popular funds platform was also touting this solution for what we call accredited investors.
Yeah.
Basically, borrowing yen and buying overseas funds.
Yeah, overseas
And
funds.
then you get a spread because a yen borrowing costs for non-preferred clients are about 2%.
2%,
Yeah,
right?
yeah.
And you invest in something.
If something that bring you like 6, 7, 8%.
So let's say you
Yeah.
invest in something where the dividends itself is
Yeah,
5%. You have a
correct.
consistent dividends.
Correct.
Capital goes up and down.
Yep.
It don't matter,
Yep.
right? Because you have 5% dividends coming up.
Yep.
You settle the 2%.
Yep.
You make a 3%.
You make
there.
a 3%.
At least that is a pitch.
So the advantage with this solution is that unlike with the insurance policy one, you don't have to wait because when you buy into the fund, the dividend probably comes in next month.
Right.
There's no 3-year waiting period or accumulation period, as we say.
Right.
in insurance.
Right. Okay. Yeah, fair enough. So
And the other advantage is there is no loss in early surrender.
yeah, okay, you can sell anytime.
You can sell anytime.
So in
I
your
can sell
name,
next
you
month
can
if
sell
I wanted
anytime
to.
and
Right.
everything else,
Yeah,
right?
correct.
Yeah. Sometimes I wonder, right? Sometimes I wonder if it's such a good way of doing it. And all these platforms which is actually they have a lot of float. What I call a lot of float as a market maker. You need to have that amount of float and everything else, right? You could do the same. The market makers could do exactly what they're promoting the retail market.
They can.
And they can get the 5%, right?
Yeah, they can.
Maybe they are doing it, but obviously we also know
Mhm.
they're also not allowed to take so much of risk.
Yeah,
right,
correct.
right.
Yeah.
So of course diversifying in the risk,
Yeah,
getting
correct.
money from elsewhere,
Again,
getting other people
let me
chance to
stress
get
again,
in.
this one is for accredited investors who
Yes.
are deemed to be more knowledgeable.
Yeah.
Yeah.
I mean, in the investment world, sophistication, right?
Yeah,
So somehow sophistication is very closely related to your net worth and how much value that you have and
correct.
everything
So
else, right?
if you have this amount of net worth, you're assumed to be more sophisticated. You're
Yeah.
assumed to understand the risks
I've
better.
known fishmongers with a very high net worth value.
Yeah.
Okay. So anyway, not every concept is free. There's always some flaws in certain concepts and everything else. But anyway, we discussed about 2-3 things where we see margin financing and we do see some of this acting up again, right? As we see the interest rates coming down, right? As we see and as we talk and we discuss, there's no such thing as free lunch. There's always a risk. So understand your risk, but most importantly, right? Understand your risk profile.
Yes, correct.
Right.
Understand your financial planning objectives. Make sure you're not losing your pants, right?
Yes.
Importantly, because with some of these instruments, you can actually, end up in severe financial consequences.
Yes.
Very dire ones. Yeah.
Very dire ones. So so there's no such thing. I mean, everyone likes to tout the fact of quick wins, right? Of quick victories or what do you call you got to strike the deal right now, right? I think in all circumstances you can wait. Right? I think it's worth the wait, worth to think through things like this margin financing, especially when it's a sophisticated concept, sophisticated deal, and the fact they don't open it to everyone tells you something.
Tells you something. It does tell you something.
Yeah. So I think on that note, and until to the next call, have a good one and stay safe.
Cheers.